Disney stock is moving up very nicely today, and this is just after they reported their Q3 2023 earnings. I know that might sound weird because we just finished Q2, but Disney does their reporting a little bit different, so they actually just reported their Q3 2023, not to be confused. As we look at the S&P 500 heat map for the day, it was pretty much a flat day across the board. There were some weak sectors, there were some strong, but if we see in the middle here, Disney was actually the biggest mover in the entire S&P 500 at just under 5% on the day. So needless to say, the market is very excited about this Q3 earnings report that Disney just reported. We're going to talk about all the good things, all the bad things, whether or not I still think Disney is a buy. I actually have been acquiring Disney shares over the last few months. We're going to talk about all that in this video, but first, if you're new here, I'm Austin. I'm a co-owner of CloudBusinessWeek.com. I'm a stock market investor, and like I just said, I am a shareholder of Disney. It's not an insanely massive position for me, and I'm not going to build it into an insanely massive position. It's not going to be like a top 5 core holding for me, but I do want exposure to Disney stock because I see a nice turnaround play starting in Disney. Real quick, if you're new to the channel and you're not subscribed yet, become one of those 1,700 or so people by clicking that subscribe button and dropping a like for me. As a thank you for doing that, here's a picture of both my cats, Millie and Luna. Millie's the gray one, Luna's the brown one. Thank you for subscribing. Okay, let's get into this with Disney. First, I want to give my opinions on the quarter they just reported, and then I want to talk about all the commentary, why I think the stock's moving up, and where it's going to go over the next few months. The earnings that were just reported, in my opinion, were not great. I was not excited to see multiple things in this earnings report, and we're going to talk about what those things were that I didn't like. But the commentary from Disney is what's really moving this stock up. There are some stocks in the stock market and some CEOs of companies that trade on the stock market that are so good at showing the vision of where the companies are going to go over the next few quarters, over the next few years. Bob Iger is one of those people. If you didn't know, they had a CEO transition away from Bob Iger to Bob Chapek. It was not a good time. Shareholders didn't have a good time either while Bob Chapek was CEO. And then they basically pushed him out and pulled Bob Iger back in so they can restructure the company and move it into its next growth cycle. So far, Bob Iger's doing a very good job of explaining to Wall Street, explaining to investors, explaining to hedge funds where Disney's going to go, and everyone's very excited about it, clearly based on this 5% move that we just saw after they reported their Q3 earnings, even though, like I said, there were many things in this Q3 earnings report that were not good, just flat out, straight up not good. So one good thing we see on the income statement is that we've actually got revenues rising by about 4% on a year-over-year basis relating to the same quarter a year ago. And that's about a 4% increase, like I said, and then expenses related to running the business only increased by about 3.2% when we take that 19.7 million versus the 19.07 million from a year ago quarter. So the revenues are increasing faster than expenses, so that's a good thing to see. What we don't like to see is this restructuring and impairment charge. This is very necessary related to their CEO transition. I wish they wouldn't have had to go through this situation anyway, but the restructuring impairment charges are the sole reason that they were EPS negative on a GAAP basis. $42 million last year in the same quarter of restructuring impairment charges, and then $2.6 billion of restructuring impairment charges this year. That's going to start to drop off a cliff, and this company is going to get back to those EPS positive numbers very quickly. I don't know if it'll happen in Q4 for Disney or if it'll happen in Q1 of 2024. And remember, the reason I'm saying Q4 and Q1 rather than Q3 and Q2 is because Disney's on a slightly different fiscal reporting schedule. So I expect to see that net income from operations number get close to that 1.5 billion and actually pass that 1.5 billion over the next 4 to 6 quarters. I don't know how long it's going to take, but I do have faith that they're going to get back to that 1.5 billion plus of operating income. And as the net income from operations increases, net income overall is obviously going to increase. We're not going to stay at this negative $460 million of net income. Disney's going to bring those restructuring impairment costs down as they finish the restructure, and then we'll be back to beastly profits as we move through the next few quarters. Is this an issue? Not necessarily. It's not great to see negative net income from a blue chip stock like this, but it's not like Disney's going to go bankrupt in the short term. They've got over $11 billion in cash, like we'll look at later. They're in a great spot. There's no real chance of doom and gloom bankruptcy off this singular quarter of negative GAAP net income. Moving down to the balance sheet. The balance sheet's in a pretty dang good spot as it relates to current assets and current liabilities, as we see that we have over 11 billion in cash and only about 2.6 billion in current debt. The rest of those current liabilities that we see there are deferred revenue and accounts payable. And we can expect both those numbers to be relatively flat on an ongoing basis as long as we see that current debt not start to rise and we still have that almost 4x coverage ratio as it relates to cash versus short-term debt. I'll still be in a happy spot as it relates to short-term debts and short-term assets. On the long-term debt side, I've never liked the long-term debt situation with Disney. I do understand that this is an asset-heavy company. In order to have those assets and continue to keep those assets in good working order, it's going to take debt. It's not reasonable or even possible to pay cash for all these hard assets that they have on the books, so they are going to take out debt for that. I don't like to see long-term debt right now because of the high rate environment time we're in, but as long as we're not taking out new debt right now, I'm probably going to stay a happy camper. I wish the balance sheet was in a better spot on a long-term basis, but it's not trash and it's not terrible. All right, the next thing that I didn't love from this earnings report is those Disney Plus numbers. I'm not just talking about Disney Plus, but I'm talking about the whole direct-to-consumer side. So when we look at this line item in the earnings report, it says direct-to-consumer, and we're looking here at the operating loss attributable to Disney Plus, Hulu, ESPN, etc., all of the streaming side of the business. In the year-ago quarter, they had a $1.06 billion loss. $1.06 billion loss just from the streaming side of the business. This year, although it's way, way, way better, they cut that loss in half and they beat expectations on how much of a loss it would be. It's all the way down to $512 million. Let's not lie to ourselves. $512 million is still a very big loss attributable to the streaming service, and they've really got to get that under control, but the commentary was extremely strong that they feel really good about getting that to a profitable spot over the next few quarters. A 50% improvement is very good. Cutting the loss in half is very good, but losing $512 million just on the streaming side of the business is still not great. They announced a massive wave of price hikes as it relates to pretty much every streaming product that they have. That's going to go a long way to help out with getting those losses under control and flipping the net income as it relates to the direct-to-consumer side of the business. That's what's going to lead to the next leg up for Disney stock specifically, is getting that streaming side of the business to be profitable. One issue with this is that typically when companies are taking losses, they're in a massive growth cycle as it relates to that part of the business. But the entire direct-to-consumer side that they lost $512 million on is definitely not in a hyper-growth cycle right now. They only increased total paid subscribers by 1% on that side of the business. So that's the big red flag with this, is that they're not in a massive growth cycle and they're still losing massive amounts of money. So what's the path forward to profitability? It's going to be those price hikes, and it's going to be restructuring. That restructuring impairment cost that we talked about earlier of $2.65 billion, that's going to help out a lot over the next few quarters to get Disney to cut costs on the streaming side of the business and go ahead and flip to operating profits. But Bob Iger is totally back, and he has given some super strong commentary around the direct-to-consumer side, which, like we said, is that streaming side of the business. He said right here, the company has improved DTC operating income by roughly $1 billion in just 3 quarters as Disney continues to work towards achieving DTC, direct-to-consumer, profitability by the end of full year 2024 in this challenging environment. Yeah, you see, he likes to put that in this challenging environment part, like, yes, this is difficult for us, but hey, we're going to do it because we're a beast company and we're a beast management team led by me, Bob Iger. He's such a great salesman. He really sells the stock's future to the investors. It's great. He also talks in the highlighted comments about the aggressive cost reduction across the entire business, with the company on track to actually exceed its initial goal of $5.5 billion of savings this year. Of all the commentary on the entire earnings call, almost 70% of it was just about the direct-to-consumer side. So Bob Iger understands that that's why this stock has been thrown in the trash recently. And until they get to that operating profit and they show consistent progress quarter after quarter after quarter, the stock is going to stay in a rough spot. And remember, the entire management team at Disney is all massive shareholders of Disney stock, so they're going to benefit greatly as the stock gets to higher levels. As the streaming side, he talked about how there's continued strength in the parks and experiences. US parks are okay, the cruise lines are in an amazing spot, and then the Asia parks for Disney have been doing very well. And then the last big thing he addressed in the earnings call was around the film side of the business. He said Disney Film Studios are reducing the number of films that are going to be released, but also focusing on better economics around it and trying to reduce the cost per title that gets released. This has been a big area of weakness for Disney recently, with multiple movies that they put in the box office just not having a great time and not performing well generally. So it was nice to hear some commentary on cost-cutting efforts, worrying more about the economics of releasing the films, making sure they're doing less films that are better produced, that are ideally gonna do better in the box office flat out. Now, the only thing bad about a CEO like Bob Iger, who's really, really good at selling the vision of where the company's going over the next quarter, 2 quarters, 3 quarters, and multiple years, is that they have to deliver on all of these promises, or else the company's going to be thrown in the trash again. I do believe in the Disney management team to execute on all these promises, but some of them are really big statements. If we continue to see box office weakness, let's expect downside in the share price. If we continue to see big losses on the DTC side and it's not decreasing very substantially quarter after quarter, let's expect more downside in Disney's share price. So it's like a double-edged sword. It's going to be great, and it's going to be a huge benefit for Bob Iger to be selling the future of Disney if they can execute. If they can't execute, it's actually going to mean an accelerated downside for Disney stock. I think as an investor, you just got to decide, do you believe in Disney enough? Do you feel like it's a strong enough brand? And do you believe in Bob Iger enough, who has led this company for years and years and gave shareholders an amazing return over the time that he was there? Do you believe in it, and do you believe in him? If the answer is yes, there's no side of the business that's so fundamentally terrible that you just have to stay on the sideline, in my opinion. So for me personally, 1, I do believe in Disney. 2, I do believe in Bob Iger, and he has an amazing track record as a CEO. He's great at selling the vision. As long as they're continually executing on his vision, we're going to be good to go. It's going to be smooth sailing with Disney stock price. I believe that's what's going to happen. I don't know. I can't predict the future. I can't see the future. But with Disney at these depressed stock price levels, as it relates to their price to sales and their price to earnings and their price to book value, I just have to be a buyer of Disney stock still. I will get to a point where I've reached my share goal. I don't know if that's going to be over the next 6 months. It depends on where Disney stock price is, how heavy I continue buying, but I'm only going to get this to about 4% of my total portfolio. So it's not like I'm going all in on Disney stock or anything, but I am going to continue to be a buyer of Disney. I am very excited about the future. I see them riding the ship. I see us riding this great turnaround play. This is a very similar path forward as I saw for Lockheed Martin at the beginning of 2021 when I was buying shares of that. It's been very good to me. I've got somewhere around a 50% return. I've gotten awesome dividend money. I do see the Disney dividend coming back still. We didn't get any insanely strong commentary around that on the conference call. They were really focused on the DTC side of the business, but they did say prior that they were going to reinstate the dividend by the end of 2023, which is coming up real soon here. So I see a very similar situation playing out with Disney as I had play out in my portfolios with Lockheed Martin, which is a very large holding for me that I haven't bought more shares of since early 2021. Most importantly, all this, let me know what you're doing out there with Disney stock. I want to know if you're buying. I want to know if you're staying on the sideline still. Are you shorting the stock? Are you doing any option plays? Let me know what your situation is with Disney. I want to hear about it. This is a very controversial stock. The last video I published on Disney stock, the comments were very polarizing. Some people love Disney stock. Some people hate Disney stock. It was kind of entertaining to see. So I want to see your comments down below. That's one of my favorite parts of posting here on YouTube. I appreciate you being here, and have an amazing day.